The Japanese yen has not been this cheap since 1990. That's 34 years, or more than 3 decades. And while it's inviting hordes of tourists to Japan, I was just there a week ago and I saw it firsthand, it is also ringing alarm bells for the Japanese government. Everyone is talking about Japanese currency intervention, and that's what I want to explain in this video. What it is, when it could happen, what to watch for, and how to trade it. Hello everyone, I'm Kathy Lean with BK Traders, and whether you like it or not, fundamentals matter. Now make sure you subscribe to my channel for more updates and if you want to learn how to trade with fundamentals, because when the Bank of Japan intervenes, I'll be releasing a video on it and you won't want to miss it. Now, there have been few trends in the financial markets as strong and as relentless as the rise in dollar yen, which over the course of the last 12 months rose from 130 to 152, which is a 17% appreciation in the currency. The last time the Japanese government intervened in the currency was in October 2022, when it was trading around 150, 190. Now this past week, dollar yen broke above that high, putting it into intervention territory. Now, why are traders and investors so worried about intervention? Intervention is a big deal. It's a big risk because typically a pair like dollar yen will have an average daily range of 50 to 100 pips. But when intervention happens, dollar yen could rise or fall 300-400 pips in a matter of minutes. Just take a look at this 1-hour chart, which shows the volatility in dollar yen when the Japanese government intervened in the currency in October 2022. At the time, dollar yen was soaring and the Japanese yen was falling to 3-decade lows, just like it is right now. And in order to reverse the rise, the Bank of Japan came into the market and bought the Japanese yen, sending it down more than 500 pips in less than an hour. And that day, the range in dollar yen was 500, not 100 pips. As you can see, intervention can lead to quick and powerful moves in the currency, 150 to 400 pips in a matter of minutes. The timing, of course, is often a surprise because the whole point is to catch the market off guard so that central bank can stop out traders who've been betting against them and to punish them and magnify the move in the process. Back in 2011, when the Bank of Japan intervened to buy dollar yen, which hit a record low, their intervention efforts actually drove dollar yen from a low of 75.57 to a high of 79.50, almost 400 pips. 90% of this move happened in the first 35 minutes. Now, we want you to take a minute to imagine what it must be like trading dollar yen at the time. If you were long, trying to stay with the trend and test the resolve of the central bank, because the trend is your friend, right? You would have been stopped out quickly with major slippage, which means bad fills. If you were short, your profit target would have been hit quickly. Great. But if you tried to get back in after the low, it was a nasty fake out reversal that would have surely stopped you out, even though eventually the intervention effort worked. So this is why trading intervention can be so tricky. Why do central banks intervene? That's the next question. And what's the uncle point for the Japanese government this time around? First, it is important to understand that some central banks are always intervening in the currency to maintain or peg a fixed value. But the central bank intervention that we're talking about are the rare ones that happen when a government actually becomes uncomfortable with its exchange rate fluctuations and exchange rate value. An excessively strong or an excessively weak currency can be very problematic for a country, especially one that relies on exports. A strong currency in that case makes their goods more expensive to importers from other countries. Now, most central banks of exporting nations like Japan will intervene or come into market to sell the Japanese yen and reduce the value of their currency when it comes too strong because they don't want to threaten growth and the export sector. And they're much more eager usually to intervene in the currency when strong than weak. However, there are also times when countries have to intervene to prop up the value of its currency when it's too weak. I remember when the euro was launched, it was plunging in value and the ECB had to come in to buy it. That happens also if policymakers are worried about investors losing confidence in the currency, or their domestic companies are complaining about a 17, 18, or 20% rise in costs due to exchange rate fluctuations. The Bank of Japan raised interest rates for the first time in 17 years in March and dropped their long-standing yield curve control. There's no question that they certainly hoped that that would do the trick, mark a bottom for the Japanese yen, finally causing it to rise. But instead of appreciating in value, the yen dropped to fresh 30-year lows versus the US dollar. And you can bet the BOJ was not happy with that. The Bank of Japan is not ready for a follow-up rate hike, so the focus is on currency intervention. Central banks usually start with verbal intervention to try to influence the exchange rate, hoping that the mere threats of physical intervention would be enough to halt a currency's one-way move. That's the stage that we are in right now. Japanese policymakers have been warning about speculative moves, calling them one-sided, disorderly, not in line with fundamentals. The next step and the next thing to watch for are rumors that the Bank of Japan is checking dollar-yen rates with their local banks, which suggests that they're getting ready to intervene. The rumors themselves could move the yen violently, and only after that will we actually see physical intervention. So far, we've only heard verbal intervention, but rate checking could happen soon. But there's one wrinkle. March and April are typically the weakest months of the year for the Japanese yen. So intervening now would mean that the government is fighting against seasonal factors. Whereas in October of 2022, October and November, the yen tends to be the strongest. So intervention at the time made more sense. Also, typically, the Japanese like to intervene when the US dollar is falling or when US yields are falling. So that may not happen until you get some trend of weaker US data. The Japanese also know that intervention rarely works. Since 1985, the Japanese have come into the market 14 times to buy or sell a currency, and only 7 were successful. And all but one was a joint effort with other central banks like the Federal Reserve and the European Central Bank. When it comes to trading intervention, there are basically two main approaches. The first is to buy the Japanese yen against the dollar, the Swiss franc, with the hopes that intervention will happen soon. The risk reward should be pretty attractive because there's only so much more upside and plenty of downside when they come in. That's what we have been doing this past week with trades like Swiss yen and dollar yen. The Japanese government has been warning for weeks about the discomfort with the weak yen and threatening to intervene to prop up its value. The Swiss National Bank also became the first major central bank to lower interest rates. So Swiss yen was a very clear trade. And in this case, Swiss yen had not one, not two, but 3 zip sell signals. Intervention didn't need to happen for the trade to hit our first and second targets. We'll be looking for more opportunities like this if Swiss yen remains in our sell zone, which is when the currency pair is trading below the indicator line and the background, which reflects the longer term trend, is red or bearish. The second way to trade intervention is to fade intervention. We haven't had the opportunity to do so yet because intervention hasn't happened. But as you see in this example in dollar yen in October 2022, after the first green candle, there's usually another 50 to 75 pips of initial retracement, sometimes even more. Also, you want to make sure that you always use a stop. Because when intervention happens, it's a risk, particularly when you're holding it overnight if you're a US trader. So just beware that when there's intervention, your stop prices may not be honored. So maybe, because of the potential slippage, it's probably smarter to just trade and focus on the trades and the direction of potential intervention than trying to fight against it. Fundamentals matter. I use it every day to trade in combination with my ZIP strategy. I hope this video helps you get a better understanding of how to manage your trades and positions of what will surely be a very volatile event for the Japanese yen because everyone is watching and waiting for intervention. Now, if you want to learn more about how to trade with fundamentals or how my ZIP strategy works, check out the links in the description below, and I will see you all next time, probably when they intervene in the currency. See you next time.